All right, warm welcome everybody to today's session. We've been up from pretty early already, obviously trading through the Australian CPI data. But for those of you just joining us for the session, warm welcome as usual. Let's quickly get stuck into where we are from a risk sentiment point of view. Look, things are leaning slightly more risk on here today. Is it a risk on sentiment that I would trust to trade? Not really, right? Not in a week like this. We know that this week was going to be messy coming into it. It's month end, quarter end, half year end. You've got the idiosyncratic things that's still in the market's focus coming up on Sunday with the French elections, coming up next week with the UK elections. Then after that, we get the second round of the French elections taking place. It's just been a very, very messy last 2 weeks, right? So yes, we are seeing equities trading slightly more stronger. We're seeing more of a risk on lean to the markets this morning, but it's not a risk on that I would trade as a pure risk on play. Not without having a really good catalyst to do so. Don't get me wrong. I mean, equities are doing what we would expect them to do, which is push up, right? We spoke about this yesterday, saying that should we see a deeper correction at some stage, and that correction is coming, right? Should we see that happen, does that mean we want to be short equities? Like we said yesterday, that is not what we want to do. As long as the bias is bullish, which I believe it is fundamentally, we will be using any deeper pullbacks like we did back in March or in April rather, and May as opportunities to get back in on the short on the long side in the short term. But just because the markets are very complacent doesn't give you a good enough conviction tradable opportunity to trade this thing to the downside. Not against strong equity fundamentals at this stage. Now there's a lot of complacency. We spoke about it yesterday, which means that we can still push lower, but that doesn't give us the freedom, doesn't give us the conviction, doesn't give us the probability outcome or probability skew to want to short equities here. If we do get a pullback, and at some stage we'll use that pullback as an opportunity to get back in on the long side, but we don't want to be trading this market on the short side, not with fundamentals. That is still solid. And always keep in mind when you're looking at equities, especially US equities needs a very, very, very good reason to sell off. It doesn't need good reasons to rally, right? That should always be your baseline expectation, that as long as the fundamentals are okay, you would expect that perpetual upward drift to continue. Markets need very good reasons to trade equities on the short side. Again, at some stage, we're going to get that pullback. And when we do, we'll be ready to look for opportunities to trade it. But for now, equities are doing, at least on the US side, they're doing exactly what we would expect them to, which is pushing up, right? We had a solid day yesterday for tech. I mean, tech had a huge recovery run. Basically just recovering a lot of the downside that we had from the prior session. Real estate had a pretty bad day. Utilities down, industrials down, but technology did good. And obviously all led by, guess who? Nvidia, right? Who else? I mean, 6.7% upside for a company this size. It's just, I can't wrap my head around it. I tried to. A little bit earlier in the session, I was talking about trillions, and my 5-year-old overheard me talk about trillions, and I had to try and explain to him what a trillion is. And basically, I'm not gonna bore you guys with what I told him, but when you think about these numbers, they are so big, So think about what this means for something that's $3 trillion US big in market cap, rallying 6%. It's just, these numbers are earth-shatteringly big. But anyway, that's just me, nerding out about these things. It's just, I'm always amazed with these types of things in the markets. Anyway, big recovery move there for Nvidia yesterday. We'll see whether that continues. The markets did get a little bit of a spook with this flush lower, but like we've been saying over the course of the last few weeks now, a couple of sessions now, when something this big gives you close to a 30% rally in less than a month, you can't blame these guys for taking some profit off the table. Whether that continues or not, obviously we'll need to wait and see. But again, any type of massive dips that we do eventually get in equity futures, especially on the US side, I'll be using those as dip buying opportunities. I'm not using this as a sell the rip opportunity. I just don't have the conviction to do that right now. In terms of the commodity space, it remains messy. I had a note up a little bit earlier from BCA, who basically they view commodities in general, but more specifically gold, exactly like I do right now. It's a neutral game, right? I don't understand the fundamentals for some of these things to trade the way that they are. We spoke about, things like oil, for example, earlier in the week, where yes, supply is still constrained, and everybody is now, when oil prices goes up, there's always a supply or demand reason. When it goes down, there's always a supply or demand reason. But what they forget is that the exact same things were in play just a few weeks ago when oil prices pushed lower. You can't always cherry pick the narrative just to suit your article that you're writing. But anyway, in terms of oil, yes, supply is still constrained, but demand is a question mark on the US right now. Demand is a question mark on China right now. So we don't have the demand leg there to give me conviction to want to trade this higher, right? So that makes me stay a little bit more patient with it. When it comes to gold, we've spoken about it a lot. I don't understand why it's this high. And again, I'm not talking about the longer term reasons to like things like gold higher. We are all aware of what those longer term reasons are. If you can't, again, let's not cherry pick why something should or shouldn't be going up. When you have a time frame that stretches over the last 10 years, who cares about that? Let's look at the year and the now. In the year and the now, there's just no view. It's a neutral game. I can see reasons for upside and downside when it comes to some of these commodity markets. In the very short term, though, it's pretty messy stuff. It's very mixed. I mean, take a look at what we're working with here. You're seeing upside for oil, downside for gas. You're seeing upside for platinum, downside for gold. It's just a very, very mixed flow when it comes to commodities. Not a market that I'm too keen on trading right now. In terms of the bond market, we have seen a bit of a push lower. In bonds, pushing yields to the upside. Obviously, the star performers being Aussie yields pushing to the upside after CPI. But for the most part, if you take a look at treasuries, we spoke about this yesterday as well, treasury yields, we are trading in some very, very tight ranges right now. So yes, bonds are lower, and yes, yields are higher, but I don't think we need to make too much of that right now. We're still trading very close to that recent range we've been stuck in. I'm still holding on to my T-bond long that we got into. When was it? A session or 2 or 3 ago. I still see more reasons for yields going down and bonds going up based on the economic outlook and the recent data that we've had. Obviously, inflation, next week's data, all of those things will play into that. And we'll see whether we are right on that or not, but still comfortable holding on to that. My view for that hasn't changed. In terms of the broader FX space then, the star focus is, of course, the Aussie dollar. I mean, what a ramp we had to the upside, and the move made a ton of sense. Why? Because take a look at these inflation numbers. I mean, we spoke about this yesterday in the preview. 4% on the weighted year over year. 4.1% on the CPI year over year. Trimmed mean 4.4%. I mean, these are some seriously hot numbers. Now, to be fair, for those of you who traded this live alongside me, you will know that we actually only had that data point come out first. I jumped on the back of that because 4%, that was our minimum threshold that we spoke about yesterday. In terms of getting into a trade, that is what would have gotten us excited about trading at 4% or higher. So it was a little bit of a risky entry on my side because normally I want to see all of the data come out first, but that number was just so hot. I couldn't resist. Not with the amount of weird upside that we've been seeing in the Aussie dollar over the course of the last few sessions, which, as you guys know, in my opinion, the upside didn't make a lot of sense. Upside on this type of print, that makes a lot of sense, right? That's something that you can get behind. In terms of tradability, kept it really simple, did exactly what we said we we're going to do yesterday, trading the pound Aussie lower. We had an opportunity to take some profit actually at our 1-to-1 at around the 90-20 level. You guys can just go back to the channel and double check exactly where those levels were, but I think it was around that 90-20 level. That was the 1-to-1. And then what I did earlier, or after this, but much earlier in the session, of course, I actually took off my pound Kiwi short. Where is my pound Kiwi short? I took that off. This one over here, took it off because we had some pretty negative economic comments coming out from the New Zealand Treasury. Decided to rather just take it off there, and decided to rather than hold on to the pound Kiwi, just hold on to the pound Aussie trade a little bit longer and then just extend the profit target a little bit lower. Because this was a risk event trade, I had a lot more leverage or a lot more risk running on this trade anyway. So at this stage, this is making up, 3 or 4 fold in terms of the small loss that we took on that, on the pound Kiwi one. So happy with the way this one is trading right now. We'll see whether we get down towards that 89.30, 89.40 level. If you take a look at how pricing has changed, I wouldn't be surprised if we get there. I mean, look at these numbers. We went from a hold probability of 89 and 87 to now a very, very close to hike probability for the RBA. I mean, we were up to a hike. This is the most recent update, but we were up to a hike of about 51% for that September meeting, just a little bit earlier in the session. So I think there's more upside to be had. The one thing that is still getting me a little bit concerned about the Aussie is obviously that big divergence we are still seeing between that and things like copper prices, things like the yuan. But at least this rally, makes a lot more sense than the earlier one that we had. For me, there's a much better reason for the move, so feel a little bit more comfortable with it, and we'll see what we can squeeze out on the back of that. Apart from that, still running the other pound trades, like the euro. Where's my euro sterling? Like the euro sterling long, the pound CAD short, still like the odds of holding on to those. In terms of the calendar, guys, it's gonna be an extremely boring next 2 sessions. We've got literally nothing of interest coming up for the rest of today. We've got very little excitement tomorrow. We've got GDP, but remember it's Q1. We've got jobless claims. Maybe that could be interesting, but do we really want to trade all of that in a week like this, knowing that the dollar hasn't really responded well to these types of prints? I don't know. So, PCE is obviously coming up on Friday, but in terms of the rest of today and tomorrow, I think it's going to be a complete snooze fest in terms of economic events. The main focus will be any type of new developments we see coming out with that political stuff going on. And obviously, we'll be keeping a close eye on how our current trades are operating in terms of pound exposures and obviously the Aussie exposure we've got running from this morning. So that's just a quick look at where we are across markets. As always, any questions, don't hesitate to let me know.